Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty. Hope you're doing great. Happy Thanksgiving to everybody. I hope you're having some fun with your family and some downtime this week to enjoy with your family. I'm going to go ahead and share my screen. We're going to do our quick market update here for you guys. And I just wanted to start off with this idea that everything's so expensive right now. Housing's no different. Even though we see inflation coming down, people are still having trouble with the price of homes, and couple that with the interest rates obviously makes sense. So, we see that, 40% of under 30s, people under 30, receive family money for down payment. So they're having trouble even coming up with a down payment. A lot of these people are having trouble in this age category, are having trouble getting even a starter home affordability. And they're getting down payments from their family, from their parents. And we're seeing we actually have some solutions to this, like down payment assistance and those sorts of things. Obviously, with those programs, though, there's some additional costs, some additional interest rates you're going to run into. And keep in mind, whenever we talk about rates, we're always talking about the idea that with these rates that you always see on TV or on these websites and stuff, those are the average retail rates that are out there. So again, we work with mortgage brokers typically most of the time, unless a specialized case for a specialized program, maybe that isn't available there in the wholesale market. But those rates with wholesale lending, those are going to be with a broker about, at least I'm seeing about 25 to 50 basis points lower. Sometimes I've even seen up to 100 basis points lower. So keep that in mind. If you need some recommendations there, let us know. But roughly one quarter, 25 or 26% of Gen Z and half of 52% of millennials own their home, compared to 71% of Generation Xers and 79% of baby boomers. So roughly 40% of Gen Zs, and this is what we've been talking about with the jobs market. Up until very recently, we're telling you the jobs market wasn't that healthy as they were saying, because a lot of it was seasonal, a lot of it was second jobs. A lot of people who should be in retirement now are having to take a part-time job, and whatnot. So a lot of this isn't, great, but this is what the Fed has done in order to tame inflation, in order to stop people from spending, in order to do demand destruction, and in order to stop the growth of the economy, really, to bring inflation down. This is just how they work. I know it sounds counterintuitive that you'd want unemployment to rise, but that keeps people from spending more money and creating more inflation. So in the way that fiat currency works, which is basically you print money, and whenever you print money, you have more dollars chasing too few goods, typically if you overprint. And we've done more printing in the last couple of years than we had money in circulation up until that point. So without getting into the weeds of those numbers, we're seeing that obviously what the demand destruction is working, and those sorts of things are just, where they are now. The Fed is being very careful in the idea that they're going to say they're going to lower rates, but they have taken a pause. We're going to find out more on December 13th, which is the next Fed's meeting, on what they're going to do. Most likely, they're not going to do anything. They're just going to kind of leave it where it is. And it makes sense from the standpoint of, again, I don't agree with a lot of the Fed. They were late to the party. They caused the problem, all that. But it makes sense that they would do that in what they're trying to accomplish during the holidays, because what's going to happen during the holidays? People are going to spend more on food and alcohol and gifts. So you're already going to have that inflationary factor. And a lot of that's going to be on credit cards. So more credit card debt, right? So again, that's going to, kind of be a little bit of an inflationary factor right there. So my guess is we're going to see, through the first and second quarter of next year, as is being predicted by most people right now, we're going to start seeing them still stay at a pause or start lowering that Fed's fund rate. Some companies, some business people are even saying, up to almost 3 points, they're going to bring that down. We'll see. We'll see how that goes. I think, a lot of the economists are like Lawrence Yun are saying, between 6 and 7% next year. Those are the retail numbers. Keep that in mind. As far as mortgage rates are concerned, I think actually by the end of next year, we're going to see in the retail market really around 6, maybe high 5s, possibly a little lower in the wholesale market. We're definitely going to see, in the 5s. I'm predicting, unless again something can come out of left field and change all that. So let's take a look at some of the mortgage news here. CPI fell. That's always good when inflation falls year over year, a month over month, to nearest lowest level in more than 2 years. Core CPI strips out volatile food and energy prices, and the reason why they do that is there's certain things the Fed can and cannot control. So they look at these kind of with and without these factors. And then food and energy prices increased 0.2%, while the annual reading declined, from 4.1 to 4%, reaching a 2-year low. So that's good. Wish it could be faster, but that's what's happening. Declining gasoline and used car prices, moderating shelter costs helped keep a lid on inflation last month, even in the face of rising costs for motor vehicle and health insurance. Okay, so the bottom line there is, again, we're going to see what the Fed's going to do. Inflation's coming down, all good. December 13th is going to be the next meeting. Huge progress in wholesale inflation. So we've seen those numbers come down. The year over year dropped, which is great. Are better building conditions ahead? Well, right now the builder sentiment was down in November, as it says here, data point improving conditions for home construction in the coming months. Okay, so we'll see how that goes, but they're definitely trying to keep up with the demand, because right now we have low inventory pretty much across the country, and in the Phoenix area we have low inventory. So we'll see how that goes. Bottom line, high mortgage rates were a key reason cited for declining builder confidence, yet recent macroeconomic data point to improving conditions for home construction in the coming months. So we'll see. Plus there was a good news for buyers, as more builders, 36%, reported cutting prices. So we had the cutting of prices, and you get the end of the year deals always. That's seasonal. Never, it always happens that way. So builders want to unload the inventory they do have, the spec homes that they've already had under construction that aren't under contract yet. So they're going to offer all kinds of incentives. So right now, I always tell people, if you're a home buyer, the best time to buy a home is right now, because especially if you want to buy a brand new home, but even a resale market, because you're going to get people with ordinarily offering more price cuts, more in closing costs, concessions. They are going to be more apt to give you 2-1 or 3-2-1 buy down rates, where your rate will actually be as low as we had seen them in previous, 2-3 years ago. And then, a lot of builders buy, basically, just to kind of put it down to street level, they're buying rates in bulk. And they're basically buying down the rate for you. So I've seen some builders offering as low as, like 2.9, 3.9% on a new home build. So you can go out and buy a brand new home right now. No kidding, right here in the Phoenix area, a lot of places around the country, for, around 3%, 4%. So guys, from that standpoint, I don't think people are just not quite comprehending that, or the idea on a resale home, you can get these buy down rates that the seller pays for, that the builder pays for. There is down payment assistance. So again, let's talk, and we'll put you in contact with the right builder for the right price point. Or wholesale lender that can kind of navigate all this, and we'll make sure that you're plugged into the right home search, looking at the right properties that you can afford even today. Okay. So just keep that in mind. Housing starts rise. But more supply is needed, which, again, we've been talking about that forever, beating that dead horse. So we'll see how that goes. We just got to keep up with the new family formation, right? And remember, new inventory is always really, in reality, new homes, because most people, if they're selling a home, unless it's an investor, they're also buying a home, and investors go out and buy more homes too. So really, really, the true new inventory is the new home builds. So retail sales are down and the jobless claims hit a 2-year high. So again, that's all good news from the standpoint of what the Fed's trying to accomplish by getting inflation down. Get people to stop spending, but we're going through the holidays, so people are going to spend anyway, right? So they're not going to say too much. They're going to make it seem like we don't know yet. We're going to be close to the vest on this. Totally makes sense from that standpoint. So that's what's happening there. If we look at Mortgage News Daily, again, remember, these are retail numbers. The average retail 30-year fixed right now is 7.33. That's down, and that's good. We're getting closer and closer to that 7 mark in the retail market. Lower rates beckon some borrowers coming back. That's great. Okay. So all good trends. We see that in conjunction with that, obviously, 10-year treasury is kind of what this all centers around in reality, right? So we had some volatility in the bond market. There was some questionable whether or not people are even going to be buying bonds because the rates were so high and everything. The banks had issues, credit ratings were going down and all those sorts of things. So, these have been, these were all the way up into the 5 range. And now they've dropped. So that's all good. That's when we had that peak at 8% interest rates for mortgages. So this is a good trend that we're seeing, this drop right here right now. So we'll want to see that to continue to drop. And we'll also want to see the difference between what that is at that 4.2 there. We'll want to see that gap narrow with the mortgage rates, right? That should be around a 2% difference. So if we're seeing 4.18 right now, the interest rate should be about 2 points higher than that. So 2 points higher would be in the 6s, right? Again, that's retail market, right? So we're not seeing that yet because of all this uncertainty with the Fed, but we're going to get there, guys. Don't worry about it. We're going to get there. Okay. So the Crawford report puts out the Crawford Market Index. We talk about this all the time. This lets us know where we are in our market, whether we're in a seller's market, a buyer's market. It even breaks it down by cities, but overall in the greater Phoenix area, in a greater Phoenix metro area, this index from 90 to 110 is within a balanced range, 100 being dead center. So we are below on the market index on this middle portion here. We are below 110. So technically we are in a balanced market. We're in that balanced range between 90 and 110. Okay. Supply is low. Demand has gone up a little bit, but it's still, lower than what we want to see. If these two numbers were exactly the same, and we can see they're pretty close now, we would be in a dead center balanced market, but we're pretty much, that's where we are right now. So guys, we're in right at the moment a normal market. Remember, everything's seasonal. So unless we're talking about in the Phoenix area, like a lot of communities, everything's local as far as real estate's concerned. Every state, city, community is a little different. Here we have a lot of winter visitors. And so for the retirement communities, those are places that are really thriving in the fall and winter time as far as sales go. But the rest of the valley, is typically in normal times going to see a seasonal, we get into the late fall and winter around the holidays, things just slow down. That's just going to happen every year, no matter what, pretty much, unless we're in a crazy frenzy like we were a year or two ago. So anyways, let me just I just wanted to show you guys that. Oh, on the Cromford Market Index, I'm sorry. All the cities right now have been in a downward cycle as far as getting into the balanced market, getting away from a seller's market, so to speak. But as far as the cities are concerned, right now, Surprise, Goodyear, Maricopa, Queen Creek, and Buckeye, those are all in buyers markets. Okay. And then Queen Creek, Peoria, Mesa, again, these are specifically where we are in the Cromford Market Index. Cave Creek and Peoria are in a balanced market, and every other city in the metro area in Maricopa County, specifically, all the rest of them are in sellers markets, technically. Chandler being at the top of the list again this week, and they're at 161.7 on the Cromford Market Index, followed by Fountain Hills and then Gilbert and then Glendale. So Phoenix proper is at 132 right now. So, but Chandler tops the list at 167.7. They're in a seller's market. Is that a crazy seller's market? No. But if you're in one of those other cities I mentioned in a balance or, a buyer's market, then, you might be able to get some better deals right now. So, let's keep in mind, let's put some strategies together. If you want to talk about that, I'd be happy to. Just real quick here, just pulling this off of Twitter. And, I think I may have mentioned this before, but while circumstances remain tight, home sellers have done well as prices continue. This is from the NAR, National Association of Realtors. Prices continue to rise year over year. Okay, this is across the country. Same in Phoenix, including a new all-time high for October. Lawrence Yun said, a typical homeowner, who's one of their chief economists, a typical homeowner has accumulated more than $100,000 in housing wealth over the past 3 years. So again, and we can show this again and again, but over time, real estate goes up, even during recessions, except for 2008, which was specifically a housing market recession caused by too much inventory, which we do not have now, and then which led to poor lending practices or ridiculous lending products. That led to the crash, basically, in a nutshell. So we're nowhere near those high inventory levels. We have low inventory or moderate inventory. We're in a balanced market right now. So we're not seeing any of that. We just need to get these rates down, right? So anyways, guys, I think that will pretty much wrap it up for this week. I just wanted to make sure that we kind of went through those details. Again, I want to wish everybody a happy Thanksgiving. If you have any questions at all, let us know. That affordability issue, we hear that. We've been hearing that, obviously for a while, and we wanted to make sure we covered it for you. So if you have any other questions you want us to cover on these type of, housing reports or other little videos you'd like us to do, let me know. Put it down in the comments, send us an email, give us a call. If you're interested, reach out to us. We can kind of talk about what would work for you in your circumstances, whether you're a first-time home buyer, want to downsize, upsize. There's a lot of people right now that are looking at different options. Okay. And we definitely have the solutions that could solve whatever it is you're looking at for anything real estate or mortgage related. We have those team members here. So again, guys, reach out to us at mincolagroup.com, mincolahomes.com, and we will talk to you next time. Thanks.